Welcome back. Chapter 8? Wow, this is already Chapter 8. Yes, it is. In the previous chapter, we flew over the investment landscape at 30,000 feet to give you an idea about the historical performance of various asset classes and background on the concepts and usefulness of correlations. In this chapter and video, we'll cover correlations and portfolio choice in more detail. This allows us to start answering this problem more systematically. We're going to maintain our assumptions, same assumptions, perfect markets. No differences in opinion, no taxes, no transaction costs, lots of competitions, and we have introduced risk and risk aversion. What we haven't done yet is imperfect capital markets. And we're interested in such questions as, should we buy stocks? Should we buy bonds? Which stocks should we buy? How much of which stocks should we buy? That's the point of this video. So the first question is almost a conceptual one. Do you care about the risk and reward of each and every individual stock in your portfolio, or only about the risk and reward of your overall portfolio?
Please pause this video now, answer the question on a piece of paper, and then continue.
Why would anybody care about the individual components you consume out of your total portfolio? So we are going to assume that investors care only about the overall portfolio. You care only about your overall portfolio. So investors care about the risk, which we measure by the standard deviation, and the reward, which we measure by the expected rate of return of their overall portfolio's rate of return, and they don't care about individual components inside this portfolio. It's like politics and sausage making. You don't want to see how it's done. Now, this also means they care about nothing else. They don't care about state. They don't care about country. They don't care about politics. They don't care about environmental, social, or governance issue. They have no different consumption aspects. So about, I want something that correlates with how well college-educated people do. Or I want an asset that correlates in a particular way with my particular house. All of that is assumed away. All that we assume is you care only about the risk and reward about your overall portfolio. So such a utility function is a reasonable premise for our analysis. It's not normative. It's not prescriptive. It is descriptive. So it is trying to describe how we believe our investors can agree for what they like. Also, if you're managing somebody else's money, it's a fiduciary presumption. You are not allowed to care about such things as social investment. Your responsibility under the law is you've got to maximize your investors' return. By maximizing, of course, return, that includes some risk aspects. And we're going to go through this through a scenario. I'm going to have 4 possible states of nature. And because it's 4, I'm just going to use playing cards for that. These are states. So each state has particular outcomes associated with it. And I'm going to give you a table of that. And we're going to have 4 different investment assets, A, B, C, and D. And we're going to work with returns. So this could be in percent or in dollars. Doesn't really matter. All the algebra works the same way. So here is my world. I've got 4 different states that can come about, that describe the uncertainty, what's going to come about at the end of this year. Asset A in the first state is going to have minus 4%, asset B minus 1%, asset C minus 1.25%, and asset D plus 3%. And I got 4 different outcomes. I've got spades, hearts, diamonds, and clubs. So if I've got spades or heart in asset A, I lose 4%. If I've got diamond or clubs, I gain 6%. Take a look at this. We're going to be working with this quite a bit now. Now, what are the expected rates of returns of the 4 investments by themselves? Go back to the table and calculate them.
Please pause this video now, Answer the question on a piece of paper and then continue.
The expected rates of returns, which are just the means for asset A, was plus 1%, asset B 4%, asset C 1.25%, and asset D 3%. I've put all the four little symbols below because these are really simple averages of all four. What are the risks, that is the standard deviation of the rates of returns, of these four investments by themselves?
Please pause this video now. Answer the question on a piece of paper and then continue.
And the answer is, first, subtract the mean from each outcome. Well, the mean was 1% for asset A, so the minus 4 becomes minus 5, etc., etc., etc. Once you've taken the mean out, the demeaned mean is always 0. Then you square the deviations from the mean, which, if you look at the previous one, minus 5 becomes plus 25. Done the same in each individual cell. And the mean of those is the population variance. So the population variance of asset A is 25%. And the population standard deviations are 5%, 5%, 1.77%, and 7.07%. So those are our measures of risk. Here are our four assets: mean 1%, 4%, 1.25%, 3%, standard deviation 551770. If you were allowed to buy one and only one investment asset, which one would you purchase?
Please pause this video now. Answer the question on a piece of paper and then continue.
It would have to depend on your risk aversion. It would be either asset C or asset B. You would never buy A or D, only B or C. Why? Because B is better than A in all respects. It's got higher mean and the same risk. B is better than D, again has higher mean and lower risk. Now I'm going to define a new portfolio that is the equal weighted portfolio invested in A and B. So my weight on A is 0.5, my weight in B is 0.5. And if you remember, a portfolio is defined by its weights. So the rate of return on this portfolio is 1/2 times RA plus 1/2 times RB. What are the risk and reward of P?
Please pause this video now. Answer the question on a piece of paper and then continue.
This particular slide fills in everything that you were supposed to fill in. Make sure to compare this. The mean of your portfolio is now going to be 2.5%, and the population standard deviation is 3.54%. Okay, so here's the summary of our two assets, A and B, and the portfolio P by itself. P consists only of A and B. Can P be better than its components in the sense of having lower risk? That is, have we made lemonade out of lemons?
Please pause this video now. Answer the question on a piece of paper and then continue.
Yes, indeed. P is less risky. It's safer than its two components. The reason is this non-synchronicity. When A goes up or down, B sometimes does the opposite. They are not fully synchronized. So the only time that this doesn't work is if they always move the same way. Even portfolios of imperfectly positively related assets have lower risk. The only thing it must not be is all exactly the same. As long as this is true, having more assets in your portfolio will take down the risk. What kind of portfolio would you, a smart but risk-averse investor, hold?
Please pause this video now. Answer the question on a piece of paper and then continue.
Presumably a portfolio of many different reasonably priced assets, and assets in a perfect capital markets typically should be reasonably priced. You would even throw in some components that are priced a little bit too high. You would tilt away from them. You wouldn't buy as much of them, but you would still want them because they still take down the risk of your overall portfolio. Now, let's switch gears for a moment. Let's do a portfolio AC and a portfolio AD, and each one of these is going to be 50-50 each. So we already know D is the worst asset by itself. It has a lower reward than B and the highest risk. It seems completely dominated. First thing what I want you to do is work out for me the portfolio returns in each state.
Please pause this video now. Answer the question on a piece of paper and then continue.
And here are the answers. Compare your numbers. Make sure you've got the same numbers as I do. If you do, portfolio AC gives you a mean of 1.125 and portfolio AD a mean of 2. Work out the population variances of AC and AD for me, please.
Please pause this video now. Answer the question on a piece of paper and then continue.
Just do the same thing that we did before. That is, demean the numbers, take out the mean from each number, square it. The mean of those squares is the population variance. So for the portfolio AC, what you get is a population variance of 10.16. For the portfolio AD, you get a population variance of 6.25. Now let's put it all together. And I'm going to work with standard deviations because it's easier, so I just take the square root from this. My portfolio AC now has the mean of 1.125, but the standard deviation of it is still much higher than that for the portfolio AD. So when I add asset D, the overall risk of my portfolio A went down, more so than when I add portfolio C. Is C or D the riskier investment in itself?
Please pause this video now. Answer the question on a piece of paper and then continue.
Clearly, D is riskier than C. If you already own A, is C or D the riskier addition? Why?
Please pause this video now. Answer the question on a piece of paper and then continue.
Well, if you hold A, then adding D makes your portfolio less risky than adding C, because D is less synchronous with A. What happens a lot of the time, when A goes up, D goes down, and vice versa. And that's something you really like. Finding assets which correlate less with the rest of your portfolio is one of finance's central problems. If the rest of your portfolio is already widely diversified and similar to the overall stock market, then what you really want to do is find assets that correlate less with the overall stock market. And then what you want to do is tilt more towards those stocks, at least on the margin. That's it for this video and for the basics of diversification. In the next video, we look at the best measure of quote-unquote synchronicity, which is called beta. See you soon. Bis bald.
This chapter doesn't apply to me.
Why not?
I'm a vegan.
What does that have to do with anything?
I've nothing at stake.
That's the worst steak joke I've ever heard.
True, but still a lot better than your jokes.
Well, that's true.